And welcome to Standing on the Edge. This is your host, Randy Saplata. Today is Thursday, December 2nd, and happy Hanukkah to all my Jewish friends. Today we're going to be talking about which coin on the edge of the coin. We also have the topic of educate yourself during Think Like the Rich. And today's personal story will be make up your mind and just do something. Finally, we'll finish off the show with what would happen if. You are listening to Standing on the Edge. And when we come back, it's time for the edge of the coin. And welcome back to the show. The Edge of the Coin is brought to you by the CS Media Group. We provide the outstanding talent and you get the extraordinary entertainment. The Edge of the Coin is a segment that will show a way of opening up our mindsets to allow us to explore both sides of any situation. We're going to jump right into today's topic, which is which coin? Now, the weird thing about this one, and let me back up a little bit. Every once in a while, even though this is a small business show, I want to go ahead and talk about investing and investments, because it really is a very good thing to know for several reasons. Number one, first and foremost, you have to invest in something in order to go ahead and be productive, in order to go ahead and have a better life for yourself, in order to go ahead and be able to produce more of the things that you want, and to be able to survive and thrive, for that matter, in any and every economy. So you've got to do some investing somewhere, whether it's investing in your education, investing in your family, investing in your business, investing in your personal life, investing in your spiritual life, investing in your, there are so many different things you can go ahead and do it, even investing directly into the economy. So many different things. But most of the time, these investments are, number one, very small because you don't realize you're doing it. Or number two, they're very big because they consume a massive amount of time for you. Now, for those of you that are out there and saying, but I'm a passive investor. I invest in my 401k. I just go ahead and put money directly into my account. Somebody else takes care of it for me. And then I just go ahead and get a monthly report in doing so. Well, to you, I say good luck. Because right now, I'm not so sure that your quote-unquote investments are doing a very good job for you. And I have to say that because from personal experience, back in the day, I went ahead and worked for a gasoline company, or a convenience store company, called Quick Trip here in the United States, mainly in the southern United States, although they started Midwest and went east from there. But the interesting thing about that is that they, like many other big companies, offered us a 401k option to go ahead and invest into their company, and also to go ahead and invest in other types of investments as well, such as index funds, ETFs, and so on and so forth. And that would go into our 401k accounts, our retirement accounts. For those of you in Canada, I believe they're called superannuation accounts. And for those of you in Australia, I think that's the same thing. But regardless of what it's called anywhere in the world, it's pretty much the same thing, okay? And the reason I'm bringing this up is because when I went ahead and set aside a small portion of my my money to, quote, invest in doing so, the one thing that was not explained to me that really should have been was that these are not investment accounts. Let me repeat that. They are not investment accounts. It doesn't matter what anybody else tells you. The real thing is those are glorified savings accounts. Let me say that again. They are glorified savings accounts. You are saving up money, letting other people take that money and do whatever they want with it, and then they will pay you a small percentage of what they make. And you will hear promises all over the place, especially, and this is my favorite one from the salespeople that go ahead and do this. And God bless them. The salespeople are needed. They are really doing their job, and that's all they're doing. But what they'll do is they'll say, on average, the stock market has returned at least 7% consistently year after year after year after year since its inception, or since the last Great Depression that came about, or so on and so forth. And they're technically not lying to you, because what they said can be construed as true if you understand that it does not happen every year. What they've done is they've taken up the average all total years from, let's say, the last 100 years. Okay, they've taken from 100 years ago to today, they've added up all of those years, and then they've divided it by the number of years that are available. So you've got 100 years worth of statistics going up, down, sideways, crashing, skyrocketing, doing all kinds of other stuff, and they just bring it down into one level and say, on average, it's been trending upward. It does not take into account the crashes of the stock market, which happen generally. Many crashes happen at least once a year, sometimes 3 or 4 times a year. The big crashes will happen probably about once every 5 or 6 years, and the major crashes will happen around every 7 to 10 years. And then the mother of all mothers, so to speak, happens about once every 100 years. Now, I want to go ahead and say this, because the quote-unquote mother of all mothers that the government has told us has happened already this century, I would have to go ahead and disagree on that one, okay? Because they will go ahead and say, well, the Great Recession that we had, it was the biggest crash of all time since 1987, and that's very possible. But it still didn't compare at all with the 1929 crash that we had back in that right there at the end of the Roaring 20s. And the funny thing is, the end of the Roaring 20s, there wasn't that much in the stock market. If you were hitting $8,000 represented, then you were considered a multi-millionaire if you were all in at that point. And it crashed almost 75% over the next 10 years. And there was actually more than one crash. It was 3 or 4 crashes that were going on. I apologize for the barking. I got my dog here with me today. Anyway, like I said, there were 3 or 4 crashes again and again and again before it finally hit the all-time low about 4 years later in 1933. And then it stayed, the economy stayed depressed, meaning that the stock market as well stayed down at those final numbers for nearly 10 years. And what finally dragged us out of that depression was the beginning of World War II, where we got, or middle for the United States, where we got involved. But this is what I'm talking about. The people that go ahead and say, on average, it always goes up, and you'll go ahead and get 7% a year if you go ahead and continue going on. And compound interest is an amazing thing. So if you go ahead and take your 7% and you add on to it another 7%, and you add on to it another 7%, eventually you're going to have not just 21%, but something like 36% over the course of several years in doing so. But again, it's not considering the crashes. It's not considering the corrections. It's not considering, you can call it whatever you want. It's not taking into account those things, or better yet, they are not telling you about these things. Now, let me give you a little explanation here, okay? If you went ahead and put $100 into a stock right now, let's go ahead and say we put it into Apple, for that matter. And I know that Apple's not going to be, it's going to be a lot more than $100. But if you put it into Apple, you put $100 into Apple, tomorrow you would expect that you got $100 in Apple. But you may not, because if the market corrected overnight, you could have lost 20% of that. You could have lost 10%, in which case you would have only had that $100 that you had was now worth $90. You've lost money. But if it went back up again 10%, the very next day, you would expect that you're back to your full 100. And that is a lie. That is a lie, because it doesn't tell you the truth. If your stock from 100 dropped down to 90 and then went up 10% from the 90, that meant you only gained 90 cents. Or excuse me, $90. You only gained $9. $9 out of that one if it went up 10%. So you now would have, instead of $90, you have $99. And actually, it's even worse than that, because it's 10% of the lower correction, 10% of $99. Yeah, so yeah, your stock is worth $99, but you still went ahead and pushed in $100. You still lost money in doing so. Here's the correct truth, and here's what I want you. You can do the math yourself. You can actually do this, okay? If you want consistent returns year over year over year over year, you have to start from your baseline. Let's go ahead and take that $100 again, that baseline, and you have to continually make up for the losses that came down at least 125% of what you've lost. So if you lost $10, you really need to gain $12.50 in order to get back to you where you were and ahead where you should be from there. And that's the truth that people will not tell you at all about the stock market. This is true in every stock market. It doesn't matter, okay? And here's the main thing. If I came up to you and I said, give me $100, I will go ahead and invest it in this surefire winning thing that I've got. It's gained me so much money over the past few years, I can't lose. And then I come back to you the next day and say, give me some more money so you can put it into this particular thing. You might ask me, well, what happened to the money that I gave you yesterday? And you would say, well, it's tied up right now. It's going ahead and getting you stuff. And you might say, oh, okay, well, here's some more money, and go from there. If you believe in what they're saying, if you go ahead and just blindly accept what they're saying, then that's pretty much what you'll do. But if you came back and say, okay, where did you tie it up at? So I can then check to see if my $100 is still worth $100, or if it's just you telling me that it's worth $100 or more. Then I can go back and follow up behind you and say, okay, you invested it into the mining company. I think it's PRSS or something or other. I can't remember the name of the code, something like that. But you invested it into a gold mining company. PRNSS, I think, is what it is. And they might go ahead and say, okay, great. They invested $100 into this particular stock. It was trading yesterday at $1, which means they bought 100 shares of this stock from me. Today it's worth $1.07. So I made a 7% return. I think is what it is. No, a 0.7% return on that money. That's what I made. And then I can say, great, you gave me a 0.7% daily return, which is a great thing. Here's some more money, invest it some more in that stock. But if they can't say, or if they came back and said, well, we went ahead and invested it into WeWorks, and WeWorks is a multi-billion-dollar company, and they've been trading at $65 a share, and you got 1.3 shares to go ahead and get out of this, and you come back and say, well, WeWorks has a horrible business model, and they've been losing money for the last 5 or 6 years. Why in God's name would you invest in that? I want my money back. And they might say, well, it's tied up. I can't get it right off the bat. If I go ahead and do it right now, then I'm going to have to go ahead and cash out at what it is right now, which is less than what you had. And then I got to go ahead and charge fees for you and so on and so forth. And this is all true. That's how they work most of the time. Okay. So you've got to be very, very careful when you're doing this. Now, I said all that to say this, because the biggest thing that I keep hearing about today on the internet, on the radio, even on television right now, is investing into digital coins. Bitcoin, Ethereum, Realcoin, Fedcoin. I mean, you name it. There's all kinds of coins out there right there. I want to say there's somewhere in the neighborhood of about 15,000 digital coins that you can go ahead and invest in. And most of them are junk. Plain and simple. Most of them are junk. All right. Some of them are doing really well. And some of them are basically games you're playing while you're doing this. Okay. And when I was listening to an interview with Kevin O'Leary, who is part of the Shark Tank, you might remember him. He's the Mr. Millionaire one, the bald-headed guy, and he actually says and is a very, very, very smart man. He's a very intelligent investor. He's made a ton of money over many, many years. Otherwise, he wouldn't be in the position that he is. And he did not make it by investing 100% of it into one stock or into all of the sectors or into an exchange-traded fund or an ETF or something like that. Now, he'll say, and listen, if you listen carefully, he'll say a good idea for most people is to take it and put some money into index funds or something else. Some money. He says, I personally have some money in gold. I have some money in real estate. I have some money in the stock market. I have some money in currencies. There's all kinds of things that he has quote unquote allocated to diversify his position. Okay. Diversifying does not mean that you get 6 different gold companies and call it diversified. That's not it. You're still in one type of sector, gold. And even then, it's gold stocks. It's not the physical gold. You can't cash in those stocks and say, give me my gold. They won't do it. They will not do it. You can't buy 7 apartment complexes and say, I'm diversified in real estate. No, you're not. You are invested in real estate. But if the real estate sector tanks and takes a nosedive, you're done for. You can't diversify by putting 100% of your money into bonds. These are everything that I've mentioned so far right now, between investing in gold, investing in insurance, between investing in fine art, whatever it is you want, digital currencies, regular currencies, the stock market, stocks, ETFs, indexes, all kinds of things, whatever you want. These are not really investment types. These are investment strategies. Okay? Investment strategies. What you need to do is get a plan to use those strategies so that you can go ahead and continually make money. Now, let me say this again, okay? You have to go ahead and invest the time to go ahead and make up a plan to invest in these strategies. Let me go back to Kevin O'Leary for a second, because he was referring to Bitcoin as blood coin, meaning that right now Bitcoin is being almost, what's the word I'm looking for? Ostracized. And you can go ahead and look this up as well. It's almost being ostracized because so many places that mine the coin have to use coal to burn to produce the electricity that it takes to go ahead and mine these coins. And it takes an immense amount of electricity. And if that's the case, then there's a lot of people that are shunning this. Excuse me. Sorry, I thought I had to sneeze. They are starting to shun Bitcoin. Now, I knew this was going to happen anyway. Why? Because it was, number one, not in most governments' best interests to go ahead and use. It was not in the government's interest. It was not in the best interest of the people that wanted to go ahead and make money off the average person. They weren't doing it because it did not fit into their plans. They couldn't tax it. They couldn't go ahead and fine you for it. They couldn't even trace it, for that matter. So what do? they have to tell you there's something wrong with it. And therefore, if you use it, then A, you're being a very, very bad person because you are directly investing into companies and into a stock that is horrible for the planet. That is horrible for the sky, horrible for whatever it is. It's not going to make the planet greener. Okay. Now, you guys already know what I mean by that. I don't even have to worry about getting onto my soapbox for anything like that. But basically, it's this. The government is interested. This is every government in the world. I don't care what government you are, okay? The government, every single government is interested in one thing only, and that is taking care of itself. Taking care of itself. Even the United States, when it was first founded, when they first formed the government, they were interested in getting a governing body that took care of itself and could then go ahead and branch out and help its constituents. Since then, the United States government has become hugely, grossly bloated, over-bloated, and is now interested in one thing and one thing only, and that's getting as much money for itself as it possibly can. It's basically been compared hundreds of times to the ancient governments of Rome and how that works. I mean, and this is by people all over the world, not just myself. So you want to go ahead and remember the main things, which is that first and foremost, if you want to go ahead and invest in anything, you've got to educate yourself. We're going to go ahead and move more into that here in just a minute in our next segment. But if you don't, you can very easily lose yourself, lose your investment, and go ahead and lose faith in everything. You are listening to Standing on the Edge. When we come back, it's time to think like the rich here on Standing on the Edge. Welcome back to the show. Think Like the Rich is brought to you by Hers Decadence, offering luxurious refreshments for your body inside and out. You need to treat your body and that of your lover to a bit of luxury from Hers. You can find out what's available at Hers by emailing Heather at hersdecadence@gmail.com. Think Like the Rich is a segment designed to help everyone think past their circumstances and encourage a different course of action. Today's topic is to educate yourself. Educate yourself. Now, I did mention last segment that I wanted to go ahead and talk a little bit more about educating yourself because there are so many different ways to go ahead and invest into so many different things. If you blindly just go, okay, I'm going to take my money that I have saved up, that I have earned, that I've scraped and gotten together, and I'm going to go ahead and hand it over to somebody that I have no clue who is there. I've never heard them before. You've got to be one of two things. You've either got to be super smart and trust them, or you've got to be super dumb and trust them. Plain and simple. Because if you don't trust them, you won't work with them. I don't care who you are, unless you're absolutely desperate. And even if you're desperate, that pretty much just proves my point about being dumb. Now, educate yourself. There are many different ways to educate yourself, of course. The best ways that I have found to go ahead and do so are, number one, to take opposing views. Listen to both sides of whatever subject it is that you are looking into. Don't believe just one side, because the answer never lies on one side or the other. I don't care whether you think it's right or wrong. The truth is probably somewhere in the middle, okay? And that's why I like to go ahead and to take my first segment and call it Standing on the Edge, because the coin has, or my show Standing on the Edge, there, each coin has three sides. You got heads, you got tails, and you have the edge to stand on. I like to be on the edge so I can see both sides of it and then decide for myself which way to go. So if I'm going to go ahead and invest into my own company, and I find out that, number one, I don't know what I'm doing, then I need to go ahead and talk to people who have invested into companies similar to the one that I've got and find out what they did and what worked for them, and then find other people that had companies similar to mine and find out what did not work for them. Once I get all of that, then I can make an informed decision. Now, the interesting thing is that sounds oddly like what my high school teacher used to tell me. You can go ahead and get and make informed decisions for yourself, but you've got to be able to have everything in front of you, or at least as much information in front of you as possible in order to do so. Okay, I might go ahead and say to my wife, honey, I'm going out to walk the dog. And she might say, well, it's supposed to rain today. There's about a 50% chance of rain. So just be careful out there. And I might go, oh, okay, 50%. That means it's probably not going to happen because the weatherman's never right. And so I walk outside and I take my dog and we take 2 steps out and bam, the rain comes down. And well, I just hit that 50%. Because I didn't take into account all of the information that was going on, which is first and foremost, 50% where? Okay, that's the big one. If I looked out the window and saw a big cloud above me, then I might have been able to go ahead and make a better informed decision and carry an umbrella with me just in case. For those of you in small businesses, for those of you investing in the stock market, for those of you trying to go ahead and make a better life for yourself, you've got to educate yourself constantly. This is not a one-time thing. It's not something you can go get a certificate from and say, I'm the expert. I know what I'm doing now from now on. It doesn't work that way. You can't just go and say, I've got my master's degree, therefore I know what's happening. You can't say, I've got my doctorate degree, therefore I know what's going on. Even in the master's and the doctorate degrees, they've got this little tiny thing here called continuing education. Why? Because knowledge does not stop. Truth evolves. Facts become fiction, and fiction becomes fact. You've got to constantly update your information in order to stay on top of where you want to go and continue to do that. The minute you stop for whatever reason, you've fallen behind where you need to be. Now, here's the big thing that I want to go ahead and say right now, and I just read this right before the show started today. In the United States, in Washington, D.C., conservative government lawyers, or the conservatives in the D.C. government, they're threatening to shut down the government in 2 days. That's the day after tomorrow, over the vaccine mandates, because they don't believe that what President Biden is saying about these vaccines and having to make sure that everybody gets vaccinated is the complete truth. And they are willing to shut the government down in order to do so. Now, everybody and their brother is going to go, oh my God, we got to do something about this. They can't just shut down the government. Things are going to come crashing to a halt. We will go ahead and have chaos in the streets. Well, yeah, there might be chaos in the streets. There might be a crashing halt somewhere. But just like that rain episode that I was telling you about a second ago, it doesn't necessarily mean it's going to happen to you right there. But you need to be prepared just in case it does happen. Because when something bad comes about news-wise like that, then the first thing that happens is that the area where it was happening starts to go ahead and explode with bad news, and then things trickle down from there. So you might have riots in Washington, D.C. And I'm not happy about that. I certainly hope that's not the case, because my wife is there. She's in Washington right now, and I don't want her to go ahead and get involved into something that she's not interested in doing so. But The riots might not stay there. They might spread to Philadelphia. They might jump up to New York City. They might jump down to Charlotte, North Carolina, and of course here to Atlanta, Georgia. And because people are rioting over these vaccine mandates. Some people are going, yes, 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 everybody needs to be vaccinated. These are the pro-vaxxers. And you got other people who are going, no, 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 no vaccines. And these are the negative vaxxers. The I don't even know what you would call it from there. The con-vaxxers or vax-cons, if you will. I think I like that term, vax-con. Almost sounds criminal, right? In any case, I'm not saying that one way or another. If you want to get vaccinated, get vaccinated. If you don't want to get vaccinated, don't get vaccinated. Okay? But I want you to make up your own mind about that. My point is this. If the government shuts down, who's going to be affected most? Believe it or not, it's going to be the school teachers. They'll be the big ones because they won't get their money. The next people that will go ahead and get this is going to be sorry, I just saw another headline that was talking about the schools asking for the dismissal of this vaccination or masks or so on. In any case, the second group that's going to go ahead and get harmed by this are going to be the veterans, and those two groups cover probably about 2/3 of the retired people or people about to retire, and their investments that have been in the stock market. If the stock market crashes, those people will be the ones that get hammered most and the ones that will get hurt the most in doing so. So you guys need to pay attention to what's going on. You don't have to go ahead and get involved in it, but you got to be prepared for it. If the stock market crashes, your investment might be wiped out, and your $100 investment that you had might go down to only $90. It might go down to $80. It might go down to $50. You never know. It might even go worse than that. My point is this: if you have prepared for it, it's not going to matter so much if it goes down because you have things to compensate. That's what I want you to do. But you don't know this. And you can't prepare for it if you don't educate yourself. We'll talk a little bit more about that one later on in some of the other segments. You are listening to Standing on the Edge. And when we come back, it's time for Tales from the Edge here on Standing on the Edge. And welcome back to the show. Tales from the Edge is brought to you by the HRS Foundation, investing in future generations to ensure a better tomorrow. Tales from the Edge is a shared personal example of people and situations that I've experienced during my path to growing wealthy. Today's story is just make up your mind and do something. Why? Because nothing happens until you start. Now, if you are like most people, myself included, you might hear about something really, really super interesting, such as you heard about this fantastic stock possibility and how it's expected to go skyrocketing up in the next few hours. And you're going to make 632% returns on this. Again, what I want you to do is realize, first of all, that if you haven't educated yourself on this and notice that that is an average return and that it might or might not happen, you can't bet the farm on something that might happen, nor can you go ahead and not do anything on something that might or might not happen. You've got to figure out if you're going to do it or if you're not going to do it. When you do it, but be prepared for the eventualities that it could be very bad, okay? So, first and foremost, if you have nothing to invest because every bit of your money, 100% of your money is tied up in your car loan, in your house loan or rent, in your food, and putting clothes on your back and your cell phone, everything else like that, if you are going ahead and paying 100% of your bills, then forget about investing, because number one, you don't have the money to invest, plain and simple. Okay. This is where you want to go ahead and invest into your education. And the education is free. The education is free. Forget about the people that say, well, go ahead and pay me hundreds and hundreds of dollars. I will go ahead and teach you my guaranteed way to go ahead and do things. You can find it out for yourself for free also, and probably do better for yourself in doing so. But the cost is going to be time. It will take time for you to figure it out, okay? Now, for those of you that want to go ahead and invest and you've set aside savings to go ahead and do so, and you're dying to go ahead and use up the savings because it's there, it's ready, it's waiting, it's just sitting around to do nothing. Well, once again, I would not say take 100% of that savings and throw it into one investment. Okay, what I would do personally is to put a little skin in the game. A little skin in the game will make you tons smarter than it would have had you put everything into it. That just makes you more stupid, okay? If you put a little skin in the game, then you're starting to follow what's going on. Then you're starting to say, oh, okay, this could work out great. This might not work out so well. Either way, if I only put a little in to begin with, then I've already gotten smarter. So let's go back into this Apple production example that I did back in the first segment, okay? Where I said you got $100, you went ahead and invested it into Apple. And even though it's a fractional share and you can only get part of one, that's all right. You still went ahead and invested in it. But if you got $1,000 in savings and you want to go ahead and start thinking about this, and you know that Apple has done very well and is probably going to do fairly well in the future, then you might take 10% of that and invest into that one share or portion of the one share, whether you do it off of Robinhood or any other of the other apps, or you go through your own money manager or whatever. Although most money managers won't even talk to you unless you got $100,000 to go ahead and put into the stock market, right? And that's why Robinhood is so popular right now, as well as some of these other apps that you can go ahead and do your trading and investing in from there. The other thing that I want to go ahead and mention, though, is that, once again, like I said in one of the earlier segments, is that these are not investments. These are actually strategies, okay? Your strategy is putting money into a company that you think is very strong, and therefore will then go ahead and get better and place and produce more and greater things in the future than they have today, and therefore you'll go ahead and get some of the benefits off of that company monetary wise, in addition to helping produce that event to help other people all over the world get better and get a better life going as well. If you're doing it that way, then that's a strategy. Okay, or a portion of that's actually a goal. The strategy might be also this, or part of your strategy is that if you go ahead and take that $100 and you invest it into Apple, then you can go ahead and say, okay, once I get $200 in Apple, once my one share goes up from $100 and makes me $200, then I can go ahead and take out my $100 that I had to begin with. I've still got $100 left in the stock, and you might be going ahead and charged on this. So once again, like I said, adding that into it, make it 1 1/4. So instead of making it $200, make it $225. That way, when you pull out the $100, you can go ahead and also sell off that extra little bit there. So you've got $100 in the stock market still. You've paid off all the people that you owe if you go ahead and sell, taxes and the penalties and whatever it happens to be for doing so. And you've got your $100 original investment money to then place somewhere else. That is an excellent strategy. And that is what the rich do every single time that they cannot tell you about, because most people won't listen to them. It's boring. But if you talk to professional casino gamblers, they'll tell you the same thing. They never, ever, ever leave their own money on the table the whole time. It's got to start. Once they double their money, they will then take off the original amount that they had and put it in their pockets or somewhere else where they won't touch it. And then they'll play the rest of the time off of the house winnings. And that way, win or lose, they're walking out with the exact same amount that they did to begin with, and better because they learned more, and they might even be able to get lucky and get more money coming out from there. Okay. Now, the other thing, again, which is, like I said, putting skin in the game here, it doesn't necessarily mean doing it in one stock. As I said, if you pull out that, get it out to where you got now $100 to go ahead and use once again, and you can invest it into something else, then you might invest it into tax liens. Again, this is another type of strategy, okay? You can go ahead and invest it into a tax lien, which is basically people that have not paid taxes on certain real estate anywhere in the United States. And I'm not sure you got the same thing all over the world. You just got to figure out what it's called in your country. But the government will then say, we're taking the rights to this property until the taxes are paid on this property. And you might find an excellent property that says, okay, I'm going to go ahead and put $100 down to pay for the taxes on this property, and then I'm going to go ahead and have them try to collect it from the original owners when they go ahead and do so. If the owners pay the taxes, then, and this is just a nutshell, you'll have to go ahead and learn more into this, once again, the educating part of yourself. But then the government will say, okay, they've paid us the amount of taxes that they did plus interest, and therefore we'll keep the money from the taxes that we had. Here's your money back that you did plus the interest. And this is a fantastic thing all day long, once again, to get more money. And there's a lot of places where if you do this correctly, or in certain areas, not only can you go ahead and get the compound interest back, but the government might then say, hey, we'll give you an option. If you don't want the money, we don't want this property, we will let you take over the property for just what you paid on it. All you have to do is continue paying taxes beyond this. And you've just picked up the property for a song. But you wouldn't know this if you didn't educate yourself into this type of strategy. You wouldn't know this if you just sat back and went, well, all investments are bad. Nothing goes right. And you wouldn't go ahead and know this if you went ahead and just said, okay, somebody else knows how to do tax liens. Here's all of my money. Go ahead and invest in the tax liens, in which case they might go ahead and invest into something that that Donald Trump had done. Well, Donald Trump is going to pay his taxes on the property. He knows better. So therefore, you're not even going to be able to get into that investment. But the person who went ahead and tried that is going to go ahead and say, okay, well, that one lost. We didn't make any money. I'm going ahead and charging you a 10% return, or excuse me, a 10% surcharge fee just for using it with me. And here's your $90 back. And you go, what the flagnar? What happened to my money, and why didn't you do it properly? In which case, they just go ahead and hem and haw and come around and say, well, the market conditions just weren't correct, and they weren't right, and we went ahead and tried for something that we just knew was going to happen and didn't quite work out the same way we wanted it to, and moved on from there. Yeah, tell me a new one, Captain Crazy, right? So what else do you do? Well, you go ahead and you figure out, you learn from it, and you move on. But if you'd gotten educated to begin with, it would have made it so much easier later on also. Now, once you've got skin in the game, I mentioned this a minute ago, you're automatically smarter than you were when you don't have skin in the game. If you expect to make mistakes, which you better, because everybody makes mistakes, and you only put in a little bit, then if you made the mistake, you have not lost a lot, and you gained a wealth of information and a wealth of knowledge that you can then, and experience for that matter, that you can then use for the next time you go ahead and do this. But you don't learn anything for real until you put some money into the game. Now, my first investment, quote unquote, so to speak, and I knew that it wasn't an investment because I'd done the education to begin with. I knew it was glorified savings, pretty much, is what was happening. It wasn't going to go ahead and get me any kind of return because it doesn't have a return. But it guaranteed me that I would not lose a lot of money if I did it properly. So my first investment, so to speak, was investing into silver coins. Why? Because silver, like gold, holds their value. Now, even then, you can still lose money, which I did. Why? Because I invested it when I first started learning about it at $40. It cost me $40 to go ahead and buy my first 1 ounce silver coin. And 6 months later, that $40 investment, and by the way, here's something else that you want to go ahead and educate yourself on too, okay? Because that $40 that I paid was not the $40 that Wall Street was telling me that it should be. Wall Street at that time was telling me that it should only be $30 to $31 because that's what it was trading on at that point. But when I went to go buy my first physical charge, nobody told me anything about having the markups that the coin dealership would do, and this is normal, to go ahead and sell me that coin. It's basically like their commission is what's going on. They also didn't tell me that if I sold the coin back, they would once again charge me a commission so they could purchase it back, and they keep what's considered the spread. And this is how every investment business person will go ahead and make their money. They make their money on the spread between what you purchase that they've already inflated up and what you sell it for, which they say they can't go ahead and take the spot price, the market price for it. And generally it's anywhere between 15 to 25%. And again, as long as it's not a usurious type of amount, then it is legal according to the United States government. And this is the same all over the world. It does not change from country to country to country. Okay. So I automatically lost money by going there. But I learned a valuable lesson, which was this, that even though it holds its value, if I kept it long enough, eventually it would go to $40 and beyond, and therefore I could go ahead and continue, or if I wanted to go ahead and reap back my rewards, then I could sell it at that point. It still held its value. So the education part of it itself was that you don't purchase gold and silver to go ahead and turn around and sell it immediately. If you want to go ahead and try to make money for that, then do it through the gold and silver shares on the stock market, and you can go ahead and gamble from there. Okay. But once again, I learned valuable lessons in doing so. And so I considered this not just an investment in the silver coin itself, but into my own education also. And that's how I started learning about other types of investments. I learned about investing in real estate. I learned about investing in real estate investment trusts, which is basically the stock market portion of real estate, not the physical holding itself as well. I learned about a little bit about digital currencies. I learned a little bit about investing into regular currencies and real currencies. I learned about investing into games, and I learned about investing into gambling structures. I mean, you name it. And that was what I was doing. I started becoming an avid student of these different types of things. Insurance, you name it, I was starting to look into it, and therefore I could go ahead and get a better idea of what I wanted to put my skin in the game when it came to next. And that's what I want you to do. But nothing happens until you start. So make up your mind, do something, start something, make your mistakes, and then get better and better doing it from there. Because if you don't, then the only thing that's going to happen is you will have just wasted time. You are listening to Standing on the Edge. When we come back, it's time to close out the show with What Would Happen If here on Standing on the Edge. And welcome back to the show. What Would Happen If is brought to you by DJR Enterprises. Today's topic is this. Listen hard. And then, if you must, do the opposite. And everybody out there is going, what? That's crazy. That's nuts. Listen hard and then do the opposite? Why the heck would I want to do that? Well, the theme song for this show is called Pick Up the Pieces. And this is exactly where I want you to start understanding where the best things happen. Okay? Now, you already know this. If you have any kind of inkling about going to the store, okay? And it can be any store. It can be the grocery store. It can be the gas convenience store. It can be Walmart. It can be Amazon. It can be eBay. It can be your local car dealership. Who wants to buy everything at full price when they can get it on sale? Very few people. There are some people that will do it, but most people will say, hey, if I can get this item right here for $40,000 and I can buy it at $20,000, I'm going to buy it at $20,000. Plain and simple. It's the same thing. You go to GameStop, you go ahead and purchase the new Xbox, whatever it happens to be. And they're saying, oh, we've got the brand new one coming in. It's on sale right now if you get it today only. And it's only $955 and change. And tomorrow it's going to be $1,300. You're going to want to go ahead and rush right out to GameStop and purchase that $950 and change, whatever it is, game box that you got because it's on sale. The rich do exactly the same thing. Let me say that again. The rich do exactly the same thing, but they purchase other things that are valuable when there's a sale. Now, their sales happen in different ways. For example, if a rich person in 1999 had just gotten finished purchasing shares of Microsoft and Apple and Dell and Gateway and all these other computer companies, and they were going, I'm a millionaire. And then 2 years later, well, maybe even a few months later, had the bottom drop out of the stock market as it did, and then slowly climbed back up again to 2002. And once again, had it all wiped out one more time. Those net worth millionaires, the ones that had the $1 million in stocks, went ahead and literally had 25% taken out of them pretty much immediately. Then they really weren't paying attention to what's going on. But if the people that knew a stock market correction was coming, and that most of the time the stock market corrections happen in certain places or certain times of year, such as October, which a lot of times will be the worst month of the year when it comes to doing things and purchasing things, then they would have said, okay, I'm going to hold aside some of my money so that when the correction does come, I can then get into these stocks right here at a discount bargain. And so once the crash came in 1999, 1998, and all of these tech stocks went dropping, plummeting, boom, 25% overnight, the rich people swooped in and they gobbled up as much as they possibly could right then. And then over the course of the next 2 years, they rode that wave up and up and up and up and up. And once they got back that amount of money that they invested into those stock shares, they pulled it back out again and let the rest of it continue riding the wave. And then they realized that there was a correction about to happen again because they were paying attention, and they pulled out most of their money and placed it somewhere else. This is how they got rich. They did the opposite from what most people were doing. Here's a lesson I want you to understand. My favorite author, Robert Kiyosaki, says this constantly, and I have found it to be so true. You only make money when you buy. You only make money when you buy. You don't make it when you sell most of the time. If you buy it correctly, you have made your money right then. And the moment you go ahead and continue riding up the wave, you make more and more and more and more and more money. And then if you sell it properly, even if you sell it improperly and it's already started to lose value, you still gained massive amounts of value from what you purchased. But if you listened to the crowd instead of going ahead and paying attention to what was happening, if you listened to the people that were going, you've got to get this, it's gone up hundreds of percent since its inception, since its start, and it's only going to go up from there. And you go, oh, okay, I like this idea because this happens and it's constantly been going up. Therefore, it's going to continue to go up, and I'm going to push all in like a gambler. Well, the people that went ahead and rode it all the way up to begin with have already pulled their money out. And what happens? Boom, things crash again. You, if you've just pushed everything all in right at the last second, have lost 100%. The people that were riding it the whole time went ahead and cashed and gained all of that money and hundreds of percents more in doing so sometimes. They then took that money. They didn't let it sit still. They didn't park it in the bank. They didn't say, okay, here, Mr. Money Investor, I want you to go ahead and just hold on to this and take care of it, do what you need to do. No, they immediately found another place for it. Cash must flow. Now, let me say this also. Here's lesson number 2, okay? And again, if you do the opposite, for every high somewhere, there's got to be a low somewhere. If those people that went ahead and invested after the market crashed in 1999, and they rode it all the way up to 2001, 2002, and started getting a little shaky and started going, yeah, things are happening. It might go up, it might not, but I'm going to take out most of the money from there and let some of it continue to rise up if necessary. They went ahead and looked for something else that was already at its low and knew that it was going to start coming back up again. Well, at that point, what was it? Gold and silver. Gold and silver. So they went ahead and took their money at gold and silver that they, from the stock market, they went ahead and did, and they plugged it into gold and silver, which at that time was trading for around $200 an ounce of gold, and about, I think it was $2 an ounce for silver at that point. Don't quote me on that. You can check your own figures and find out for sure. But they plugged it into gold and silver. Gold and silver went massively rising over the next 7 years, up until 2007, 2008. And then they went ahead and, again, it started to crash also. So right before then, there were a lot of investors that went ahead and took it out of their gold and silver because they knew something was about to happen. Or they left most of it, some of it in gold and silver, and they took out most of it and they went, oh, what else is happening right now? Real estate. Real estate is just about to go ahead and crash. And sure enough, 2007, bam, the market went ahead and crashed again. The real estate market got hammered in 2008, and all of those people that had pulled out of their money from the stock market and into and out of gold and other investments that they had, plugged it immediately right up into the real estate investment world, and they started massively scooping up all kinds of real estate for the next 10 years, and they rode the wave again up from there. If you took, and I learned this particular item from, I believe it was Jim Rickards, if you took the highs of one market and the lows of another market and you inverted the one low, you could actually then take your investments and keep on massively going up and up and up and up, rather than riding the wave up and down like most people do. If you're not educated, you won't know how to do this. If you're not paying attention to what's going on around you, you won't know when to do this. You won't see the signs coming. And believe it or not, the signs are there, but most people don't realize it because they're not paying attention. They think, well, you can never see this stuff. You can never see a tornado coming most of the time, but you can feel the effects. You can see the circular rotation of the clouds. You can see the greenish color that's going on, and you might not even have that, but you feel all of a sudden the wind die down. Woo. And you're going, this is unnatural. Something's about to happen. Let me take action and prepare now. And this is how you go ahead and get the best out of your life, your investments, your business, whatever you want to go ahead and do, because you've taken action. You've learned what you need to learn. You've acted upon those things, and you continually get better as you go along, whether or not you've made your mistakes. You've been listening to Standing on the Edge. I want to give a shout out to my friend today, Lee Stroud. Hi, Lee. Thank you for going ahead and doing so. And for all of my friends all over the world, my Jewish friends out there that are celebrating Hanukkah, thank you for going ahead and watching Standing on the Edge. I certainly hope you've enjoyed it as much as I have enjoyed giving this information to you. I want to go ahead and still send you a link to my GoFundMe page if you want to be a partial sponsor in my show. It costs $1. That's all I'm asking for, $1 to go ahead and go into it. You can get the link from me for my GoFundMe page by sending me an email at joinmeattheedge@gmail.com. That's double T's, double E's, joinmeattheedge@gmail.com. My next show is going to be Thursday, December 9th at noon, as always. But until then, please, please, please remember to expand your awareness. Look at all these things that I've been telling you about. Focus on them. Find out what's going on so you can see what's coming down the pike. Think of something every day to help you on your own path. And hopefully soon, I'll see you joining me on the edge. Have a great weekend and holiday.